I personally am yielding 6.4% on my own Dr. Pepper Snapple stock, at least the shares that I first purchased in August of 2011. Hey everyone, this is Ian from ppcian.com, back with a video about dividend growth investing. Today I want to discuss the topic of entry yield and why your entry yield, in my opinion, is not that important. Let's take a real world example. One of the stocks that I personally own is Doctor Pepper Snapple. This is a beverage maker, most popular for the brands of obviously Dr. Pepper and Snapple. I personally am yielding 6.4% on my own Dr. Pepper Snapple stock, at least the shares that I first purchased in August of 2011. So for example, if I invested $1,000 in August of 2011, I am receiving $64 per year in dividend income from the shares that I own in Dr. Pepper Snapple. But you may be thinking, how is this possible? When I go to Yahoo Finance, I type in DPS, which is the ticker for Dr. Pepper Snapple. I look the stock up. It's only yielding right now a very low amount. In fact, it's yielding about 2.5% right now. How is it possible that if it's only yielding 2.5% right now, you, Ian, are yielding 6.4%? Well, this is a topic that I like to call yield on cost. I've covered this in other videos, but really what I want to illustrate is entry yield just does not matter. And what matters, in my opinion, more than starting yield or entry yield are three things. It's the growth of the dividend, it's the sustainability of that growth and of that dividend, and it's time. It's how much time you have in the market. The more time that you have and you invest in high quality dividend paying companies with sustainable growth models, that entry yield starts becoming less and less important because the dividends grow over time. So let's look at my specific example again. When I first purchased in August of 2011, my starting yield was not 6.4%. It was a 3.5% starting yield. And that's a little bit higher than the starting yield for someone buying today, but it's a lot different than 6.4% versus 2.5%. I got in at 3.5% and the starting yield right now is 2.5%. So when I purchased, Dr. Pepper Snapple was paying a dividend of 32 cents a quarter, so it was paying $1.28 per year. And when I divide that by my purchase price of $36.35, my entry yield was 3.5%. But over the years, Dr. Pepper Snapple has grown their dividend. They've grown it year in and year out. And right now, what was once a $1.28 a year yield, now they're paying out $2.32. My yield has almost doubled because they've grown the dividend over time. They're now paying out 58 cents a quarter or $2.32 per year. If I take $2.32 and I divide it by my starting price that I purchased in August of 2011, $36.35, my yield that I'm getting on my shares that I first purchased is 6.4%. Obviously, if I bought more shares today at the current price, which is upwards of $90. It's actually $92.81 as of today, which is May 31st, 2017. Starting yield is 2.5%. But again, if you have time, if you buy the companies that grow dividends year in, year out, those companies that are sustainable, does that starting yield really matter? Some of you out there may be thinking, look, if I'm buying a stock that's yielding 2.5%, I'm investing $1,000, I'm only getting $25 a year. That doesn't really change my life. That doesn't really help me. But imagine if 6 or 7 years later, history repeats itself. The dividend keeps growing. Well, that 2.5%, maybe it's up in that 6% range. If that's the case, you're not yielding $25 a year, you're yielding $60 a year on that initial $1,000 investment. And obviously for one that invests more than $1,000, the yield would be even greater in terms of dollar terms. Now, not mentioned here is the reinvestment of dividends. As one receives dividends over time, if you keep taking the dividends, putting them back in the company and reinvesting, maybe you do that yourself through a broker, maybe you do it through a dividend reinvestment plan, that's a way to accelerate yield growth even more in terms of dollar terms. Getting that money back into the stock can only fuel the machine to move quicker and to generate more income for you. So really the moral of the lesson today is, in my opinion at least, starting yield is not super important. What's more important is the time that you're in the stock, the sustainability of the dividend, and the sustainability of the growth, of growing that dividend over time. And it's just persistence, just getting in there, sticking with it, having a plan, and eventually that yield on cost can get pretty high. And I own stocks, in fact, in my portfolio that I'm doing much better than this on yield on cost. But the reason I picked Dr. Pepper Snapple as an example is I think it's one of those companies where the yield is never that high, the starting yield. This is a premier household name. It's a beverage company. They make soda. They make soft drinks. You're never going to get a great starting yield on this kind of stock. And so I picked this example just to show that even with a stock that typically never has a great starting yield, if you hold long enough, if you subscribe to the dividend growth investing model, even with a stock like that, your yield on cost can start getting pretty high. Like I said, 6.4% is pretty good. If you go out in the stock market today, try to find a starting yield on any stock of 6.4% other than stocks that may be very, very, I wouldn't say very, very, but riskier, or may have a higher tax implications, such as real estate investment trusts. So this is Ian Lopuk from ppcian.com. In terms of full disclosure, I do want to let you know that I personally own Dr. Pepper Snapple in my stock portfolio. I'm long on Dr. Pepper Snapple. And also I want to add a disclaimer that I am not a licensed investment advisor. I'm just sharing my passion with everyone on YouTube. This is a passion of mine, dividend growth investing, and this video is just for fun and entertainment. But if you do want to get out there and get started, please consider meeting with a financial advisor, discussing with a financial advisor your financial plans. Thank you so much for watching. I will see you in the next PPC Ian video.